All right, I guess we'll go ahead and start. Mark, can you hear me okay?
Yes, I
Okay,
can.
awesome. First off, thank you everybody for joining the call. Mark, it feels good to get back up on a Twitter Spaces with you. Thanks for joining me.
My pleasure.
Kind of been a crazy year so far in the industry. I think we all can see that. We've experienced it. One, for Bancor, little rough the last 5 or 6 months. But with the announcement of carbon, it appears things might start turning around for the Bancor community. Mark, I want to start at the beginning. Would you please give us a background on carbon?
A background on carbon, sure. So, in June, July, I was looking at things that we could do from a research perspective, moving into product development, where we could improve the fee earning capacity of the protocol and essentially, pay down the deficit and essentially perform CPR on the protocol and the brand. And so, one of the things that I was looking at for very early on was this idea of an adjustable or a dynamic fee. And I was having a look at how dynamic fees are implemented on other AMMs. And that was really the beginning of it. In terms of background, what was it that you were what were you hoping that I would say? It's kind of general.
It is. Well, because I know, that this all originally stemmed from, the current state of Bancor V3 and the deficit. And you had looked into a few different solutions. Maybe why was this the direction that you went in?
Yeah. So I think of the things that we were considering, and if I can see that there's a large number of people on the call that that were speaking with me personally, but back in June when we had to turn off the BNT distribution, which was heartbreaking. If you remember back then, there was a lot of ideas being thrown around, and they weren't very good. There was a time when I think that there were sort of like 3 or 4 different models that were being spoken about in very seriously, and what I would try to do was to summarize these things in sort of a single document, a kind of infographic maybe, and I added this to the Bancor discourse page. But it was about things like using like a die distribution model and trying to rethink about, what was the, how to monetize a protocol and what is the benefit for people to use it and provide liquidity in the first place and things. But yeah, these things were never very good. And that particular post that I'm speaking about, the one that I put on governance, I actually stressed the point that, I am not making this proposal. I'm simply trying to, bring some perspective and clarity to the way that I think some of these ideas should be communicated. So, even as far back as that, I wasn't really feeling very enthusiastic about the sorts of, let's say, desperate ideas that I think we were sort of orbiting, and I was much more interested in thinking of something that is actually servicing some fundamental purpose, and that has advantages, significant enough that consumers would actually be willing to pay for it. And I think that this is one of the things that has been lacking from DeFi over the last few years. I remember, again, back in that early period, having a very stressed, phone call with other, cells within our community. and is having this really frustrated, realization that most protocols in DeFi has never really had a customer. They are customers in the sense that, most of these protocols have to pay their users to use them, which is absolutely not something that can be sustained for, not just forever, but maybe for any length of time. There's no self-sustaining aspect to that. And that's really the background, is that I think that what Carbon is, and the kind of flexibility that it has, and the way that it empowers DeFi users to to have to exert their own will right over the markets, I think is important. And I think that there is still this kind of latent demand to have this type of order book-like structure inside DeFi. I think it's something that, a lot of sophisticated players have been, even vocally asking for quite a while. We know what the criticisms of AMMs have been, and we know what people have been asking for. And I've watched on, partially in horror, as things like the decentralized limit order book narrative started to take off, at least before the FTX collapse. And, I think that the writing was really on the wall, that people have an expectation to be able to do on, in DeFi with on DeFi exchanges what they do on centralized exchanges. But that's not enough, right? You can't just say, fine, here's your order book and, be happy with it. Because you can't just offer what, competition is offering. If people did come out, and if we did come out with just a normal on-chain order book, right, and all it did is what centralized exchanges were already doing, then that would be nothing to write home about. You have to do something extra, right? You have to give the market something more than what they already have. And I think that was why Carbon had to exist. And this is why this is the reason why I think it was the right choice over everything else that was being discussed or considered, because it is sufficiently unique. Yeah, go ahead.
No, I was just going to say, I've definitely seen a lot of that conversation happening, and more so, especially lately. So we're starting to get a little bit more into what Carbon is. You're talking about not just offering normal on-chain order books. Would you consider that, the fact that you don't Carbon's main feature? What is Carbon's main feature?
The Carbon's main feature is what we're calling continuous on-chain strategies, which is not something that's offered by not just any other DEX in DeFi, but also it's not offered by any centralized exchange either.
Okay, can you elaborate on it a little bit for me?
Yeah, of course. So I think, hopefully it goes without saying that people sort of understand relatively well what a limit order is and how that works. And if you don't, this is it in 2 seconds. Basically, you nominate a particular price that you would like to sell something for, and then you write it down in a book, and then you wait for someone to take that price. And that's when a transaction will be executed, and you get the price that you asked for, and the other person gets the goods that they bought. So this is a fairly common way of interacting with a volatile market. And it lends itself especially well to this sort of most fundamental of economic ideas, which is to buy something at a low price and sell it at a higher price later, right? And that is not too difficult to achieve, right? Limit order systems in blockchains have existed before. In general, you have to be very clever about how you pull it off, because blockchains don't lend themselves explicitly well to something like a limit order book. But it can be done. And there's nothing, like I said, too special about that. We've seen, things like Ether Delta already achieved this previously. And then we've seen, other AMMs around the space start to approximate something that looks like a limit order system. With carbon, though, you're not just setting a price for the asset for a particular asset that you want to sell, and and wait for that thing to be executed upon. What's also happening is that you're also nominating a price for the reverse trade, and this is like one of the things that delineates carbon, so significantly from everything else. And when you're setting up that position, right, where you say, fine, I'm willing to, to buy, or to sell an asset to the market in exchange for something else. At the very same time, you can nominate to buy that asset back from the market at a different price. And so one of the ways that this can be understood might be something like how a pawnbroker approaches their business, right? Maybe they are specializing in in trading in, Swiss watches, for example, or Rolexes. Now, when someone walks in the door and says, I want to sell you this Rolex for $10,000, you can buy that watch from them, but you're immediately going to mark it up, maybe to something like $11,000 and put it in the window for someone else to buy from you. And that's a really important realization, right? To determine the spread, right? The difference between what you bought something for and what you're going to sell it for. It is a very fundamental, a very easily understood way of approaching, the buying and selling, right? The trading of anything, whether it's a commodity or a stock or a currency or sports memorabilia, whatever it happens to be. And that is the thing that carbon does that is not really being done anywhere else. In terms of strategy, continuation, remember that pawnbroker, when he is buying someone's Rolex from them for something like $10,000 in order to sell it back to someone else for $11,000, the money that he's making, right, that $11,000 that he gets from the purchase of that Rolex in the second transaction can come back into his cash register ready to buy more watches from more customers as they walk through that door. And it's that idea of having a continuously, self-renewing cycle of, the dollars in his cash register being depleted as he takes in more stock. But then as the stock empties from the shelves, that it fills up the cash register again. That constant cycle is how he accumulates value, and that is probably the best analogy that I can think of for what these continuous on-chain strategies are. It's that process of constantly accumulating something at a lower price and then selling it at a higher price so that you can afford to buy more of that same thing again at lower prices in an infinite cycle until you choose to stop.
And that liquidity just rotates out, is what you're saying. It rotates.
Yeah.
Right. Okay. Somebody they submitted a question. They were asking if Carbon would include a limit order feature, and we spoke about that. They're also asking if Carbon will have a stop loss function.
Stop losses in this context are pretty difficult. So a stop loss, for those who don't know, is essentially the decision to dump your remaining tokens after the price gets to a certain a certain threshold. And this is typically what's used in perpetual swaps. And so it generally refers to leveraged positions. You certainly can't do it straight out of the gates with what we have. And I think that that's a good thing, because this is the kind of thing that triggers like cascading liquidations and things like that. But you could very easily script it. And so, this would require you to, for example, have your bot or whatever it is that you want to perform a stop loss for you, be paying attention to the price of something somewhere else, right? So if you are, making with WBTC on Carbon, for example, you may be using an Oracle or another liquidity pool or whatever it happens to be. Just anything that gives you some litmus test for what the price of WBTC is doing, and then after it reaches some price, very quickly adjusting your strategy, right? Your self pricing. The way that you price your WBTC tokens to basically undercut the market, right? So a stop loss is essentially that, right? If you've got a stop loss on Bitcoin to trigger at $20,000, then what your stop loss mechanism will do is immediately sell all of your Bitcoin at 9,500, right? $500 below whatever the market is selling it at. That's essentially how it works, right? I'm exaggerating it a little bit. A $500 difference would be pretty steep, but that's also not unheard of either. So that's dangerous, right? For something like an AMM to do on a user's behalf, deliberately striking down the tokens that they're selling and changing the price of them is not something that I would entertain. I don't think that it's I don't really want to flirt with that idea. But for people that are interested in having it, Carbon can do it, whereas you can't do it on another AMM. And this is because you have direct access to the pricing of your own assets, right? You can choose to sell them at any price. It's not prescribed by the protocol at all. So if you do want to set up a stop loss, you can, simply by simply by updating one variable in a smart contract, which is very gas efficient, that would effectively change the sales price of the tokens from whatever you were selling them to something that is much more likely to sell quickly.
Mark, can I stop you for a minute? I want to back up a little bit. So I want to start from the beginning. Essentially, a user, when they're using a traditional limit order or creating a traditional limit order, they're basically just saying, this is how much I want to buy this for. And when that happens, and they create another one, I want to sell this at a higher price. That's pretty much what that consists of, correct?
Not even the second part, just the first part.
Just
the limit order is, the limit order is generally when you write you write a price in a book and next to your name, and put some money on the table, and when someone wants to take that price, they will take it from you. A limit order book is really like, you can think of it as like an eBay listing, right? You put up your good and the amount that you're trying to sell it for, and you just wait for someone to click that buy it now button. That's really how limit orders work.
Okay, and then let's get back to, I want to kind of sum this up in a really easy to understand sort of way, best we can, how that is different on Carbon. I know we went into examples and things like that, but you're not just creating a limit order. You're not just putting up your good for sale for somebody to click it and say, okay, fine, I bought it. You are creating a strategy. This is what you're doing. You're creating a strategy, and you're saying, between these parameters, this is where I want to sell my token, my asset, right?
Yeah, right. So I suppose this is another distinct difference between what Carbon does and how other limit order, centralized limit order books work. And that's that you don't have to necessarily choose a single price. You can if you want to, right? Carbon fully supports, these types of strategy executions at infinitely thin price ranges, right? So if you want to sell all of your, WBTC the moment that someone's willing to buy it for, exactly 60,000 USDC, then you can set that up, right? There is no need to use a range. But for many traders, calling the top of something or calling the bottom of something, depending on what your perspective is very, very, it's impossible. No one has figured out how to do this reliably. And so what they will have instead is some sort of fuzzy expectation of where the market might be headed. And rather than call the specific top, right, and putting, all of your chips down on exactly some number being reached, it might, in general, it makes more sense to sort of spread out the sales of tokens around a certain target. And so you can think of this as being, the difference between, choosing a single number on the roulette board or a quadrant of the roulette board or something like that, right? Or even a single color. The wider your range, the more likely it is that it's going to hit. But the lower the payoff. So in a conventional limit order system, what these very sober, very disciplined traders will do is they will layer up a very large number of limit orders in the direction that they're hoping to take profits in. And so this could be, dozens, if not hundreds of different limit orders, all at specific price points. And this all sits on the order book, waiting to be, waiting for a taker to take that price from them. Whereas on Carbon, you can do it continuously. So rather than having to set up individual prices and committing a certain amount of tokens to those prices, what you can do is just set up a range, and then have that limit order be executed continuously across that range. So this is already, this is describing a behavior that people already do, right? This is not a significant re-education for a very large swathe of the market that's already used to this concept. But what it is doing is giving them a specific tool that makes that type of behavior so much easier to execute.
And that continuation comes in because you're setting up, or a user would be setting up a second range where that is essentially accumulating.
Yeah, correct. So again, on a centralized limit order system, I have never seen the option to automatically use the funds that are generated from the sale of something, from like one of my orders being taken, to immediately feed another limit order. Right, that's just not how it works. In general, your tokens are sold. The tokens appear back in your account, and then you need, or the dollars appear back in your account, and then you need to take those dollars and manually put them back into the limit order book in order to buy something on the way back down. So this can be, by the way, kind of frustrating for traders who are executing something that's a little bit more high frequency, right? And I don't mean like high frequency in the sense that we would talk about high frequency trading, but something like a channel trading or range trading, which is a very, very common method for day traders to turn a decent return for themselves. And that kind of channel trading can mean that the difference between the top and the bottom on any particular day, right, or even on a 4-hour timeline, can be relatively small, and so your range might be actually quite tight, and the spread that you are committing to might be relatively low. And so to sort of sit on the exchange constantly, waiting for your orders to be executed, and then quickly creating an equal and opposite order with the funds that were returned to you to rebuy on the towards the bottom of the channel. can mean that, I've spoken with people that have, had to stay up for like, 24 hours or something, because, their channel trading was going quite well. And, they're not adjusting their strategy at all, but they need to be there constantly with their, finger on the mouse, making sure that they keep that liquidity cycling back through the order book. Whereas in carbon, you can just say, you can just announce ahead of time what it is that you're trying to do. And, rather than the protocol enforce its own, particular market making strategies on you, you instead, you give the protocol instructions on what to do with the tokens that you're providing. So yeah, it's a dramatically different paradigm, not just for AMMs, but also for people that are doing these kinds of activities like channel trading. It's it should be very natural. It should feel very, very similar to the kinds of things that they're already doing, but it should also feel sort of purpose built, a lot less clunky, a lot more streamlined, to support that kind of activity.
Is that what you meant earlier when you were saying that you wanted to empower users, specifically DeFi users?
Yeah, the velocity of these tokens is really important. You do want you want tokens to change hands as frequently as possible. One of the things that I think, and I've said that, I feel like I've said this an awful lot, but I do think that one of the biggest problems facing the industry is still illiquidity. I might point out, although it does feel a little on the nose, and I don't want to I don't want to make too large of a point of it, but even the FTX collapse, for example, it isn't necessarily about insolvency. It has a lot more to do with illiquidity. It's not necessarily that they had no collateral. It's just that the collateral, or the majority of the collateral that was backing their loans, is sufficiently illiquid that no one can sell them. And this has become something of a cliche, I would say. And I think that this is one of the things that we absolutely need to address, if our industry is to succeed. And, day traders are kind of they can be the lifeblood of systems like this, right? Giving people ways to very quickly turn tokens around and flip them. It is healthy, right? It's something that we should be excited to see more of. And taking it kind of off of centralized exchanges and bringing it back into DeFi, which is, I feel like why we're all here in the first place anyway, is nothing but positive. That is exactly what I meant when I said I want to empower users to do the things they're already doing, but to do it in a DeFi way, not in a centralized, exchange way.
Right. Okay. So when you say, cycling liquidity, how the protocol does this for you? How does the protocol do this for a user?
So that cycling liquidity is achieved by using what we're calling asymmetric liquidity positions or asymmetric liquidity strategies. There's a bunch of different marketing terms that are kind of orbiting these ideas, but essentially, when you are providing two tokens in a pair, rather than have the protocol use a single bonding curve to determine the exchange rate between them, which is what has been status quo up until now, where any bonding curve is defined by two token balances, and the price between those two tokens is some expression, some function of their ratio. Instead, the bonding curves on carbon will quote a price based on just one token balance, which is really interesting. And so this means that if you're providing two tokens to a pair, because you now have two token balances, each one can be represented by its own bonding curve. And that's the real trick, right? That's how if you look under the hood, that's really what allows this thing to do everything. Yeah, I'm not sure if I answered your question correctly.
You did. You answered my question. In terms of the single bonding curve, then I think this is kind of where I've seen it mentioned that orders are irreversible on carbon.
Right.
I feel like that kind of falls into the single bonding curve versus these two bonding curves, one per token.
Yeah, correct. So maybe we should talk a little bit about, you know, symmetry and asymmetry and kind of what it means in an AMM context. Um, the you know, if anyone is already familiar with constant product or, you know, AMMs in general, maybe you can just, you know, I can feel you rolling your eyes, maybe the obviousness of it, but hear me out for a second, because not everyone understands things as well as you do. But essentially, when you're navigating a trade around an AMM, what you're really doing is kind of choosing two different points on a graph, right? On some curve, and then you're saying that the trader is essentially changing the token balances inside the AMM, so as to move from, you know, one point on the chart to another point on the chart. Fine. What's interesting though is that if they had, you know, if they had moved between two different points on the bonding curve in one direction, they're kind of freedom to move between those 2 points in the other direction, and the only thing that they would have had to pay, you know, in a permanent sense, to the liquidity provider that allowed them to make these movements, is the swap fee, which is tiny. So maybe the best way we can describe this is coming back to the Rolex example, right? And the pawnbroker who is operating some sort of, you know, some sort of pawn store. If someone comes in through the door with a valuable, you know, Swiss watch, and you agree to buy it from them for $10,000. Imagine, you know, someone coming into the store and then telling you, okay, you bought that watch for $10,000. But you can only sell it again for $10,001, right? And that's your swap fee. Like, it seems silly, right? Like, that's already not how, you know, these kinds of businesses work. Their markup is usually something significant. And more importantly, the markup is something that they're free to choose. So if you are going to the risk, right, of purchasing, you know, an item from someone without knowing, you know, if or when it's going to sell again, then people tend to get more ambitious about how they're going to price it. So, you know, if you're buying that Swiss watch for $10,000, maybe instead of, you know, wanting to sell it for $10,000 and just $1, you are going to mark it up to $11,000 or $12,000 or something like that. And this is actually how, you know, things like Swiss watches tend to maintain their value over time, right? Because they are big ticket items, and you know, whoever is you know, wherever you're able to sell them, the people that buy them from you tend to mark them up before they resell them back into the same market again. So it's that process. The typical AMM, right, is the case that we just discussed before, that says, no, you have to sell it back to the market for the exact same price that you bought it for. You can take a little bit, right, like $1, but otherwise it has to be the same price. In carbon, we're doing the opposite. We're saying you get to choose. You can choose whatever price you want, and there's nothing that the protocol can do to stop you. And I feel like the latter is a much more natural way to run a marketplace than the former.
Right. And this is where those two curves come in then. You're setting your parameters, one for each, and ultimately you're choosing where you're buying, where you're selling, and that liquidity is rotating out. So you're not obligated to sell at the point that you bought it at.
Yeah, correct. Like, you know, I mean, maybe one day we can run like an automated, you know, pawn brokerage on top of carbon. But essentially, you could say, yeah, you know, I'm setting my buy Swiss watch curve to 10,000, and I'm setting my sell Swiss watch curve to 11,000, meaning that anyone who wants to can sell me their Swiss watch for $10,000. But anyone who wants to buy one from me can only buy it from me for 11,000, and that difference is the spread, and that's you know, the dollars that you're making from selling Swiss watches are always funding the buying of Swiss watches at a lower price, and vice versa, right? The sale of Swiss watches are always funding the buying of more Swiss watches at a lower price, right? That is the cycle. This thing is self perpetuating.
Somebody actually asked a question. They're using DAI as an example. And what they asked is, can the DAI from a sell high be put to idle, or does it have to feed the buy low curve?
It doesn't have to, right? Obviously, this is one of the more interesting and significant things that you can do, but we don't force you to do it. If you were, for example, looking for an exit, if you decide that after Bitcoin gets to $1 million, right? You just want to retire or something like that. You don't really want to buy it back again. You're done with the game. So what you might do then is say, okay, fine. I'm going to set my my Bitcoin to all sell at 1 million, and that's it. I don't want to buy it back. You can do that. But coming back to what something that we mentioned earlier in the call, if you are nervous that calling the top of Bitcoin at 1 million might be, too optimistic, maybe, you'll want to start selling at 500,000 up to 1 million or something like that. And again, you can do that. All of the DAI or USDC or whatever stable token is that you are wanting to receive in exchange for your Bitcoin, that it will still technically go into another order, but that other order will be disabled, right? Will be inactive. So yeah, you can send those things to idle, and it won't be rebuying tokens with them if that's what you want it to do.
Okay, and then another question using the same example that you just gave. Say you're selling your Bitcoin between 500,000 and a million, right? That's the parameter that they set. It's evenly spread throughout that $500,000, or what they're asking is, can you set up a strategy so the majority of tokens are sold, higher once you get towards that $1 million range? Or would this be two separate strategies that they would establish?
Yeah, in that case, it really depends on the type of profile that you want to set up, and we should probably spend some time with our community and the people that are asking these questions to sort of show them how they can structure something like this. But I've already answered a question like this one with someone over the phone just recently. There may be times, depending on specifically what kind of how you want to structure your situation, but there may be times where you want to sort of front load something, like sell a lot of stuff right at the beginning, and not so much towards the end because you think it's too ambitious or you'll never actually reach that price. And there's a way that you can do that. Not necessarily by, having just one set of smart contract variables describe your position, but by having two sets. And so, like in the strictest sense of the word, this would be two different strategies from a product perspective. But this is just marketing terminology, right? The strategy is just a programming object on Solidity. You can have as many of these as you want. And so if your desired behavior is best described by having several overlapping strategies, then so be it, right? It's a pretty cheap system to interact with, and so there's really no problems there. But otherwise, it's going to follow the familiar sort of hyperbolic behavior of the constant product bonding curve. So if people are for the resident mathematicians out there, essentially you can treat it as being quasi linear and logarithmic space, right? Otherwise, it is it still follows that hyperbolic curve.
Okay, and what happens? This is another question that was submitted. When the price is outside of all of these curves?
Yeah, I mean, I think and this is another thing that I get asked quite frequently, not just about Carbon, but I remember being asked about it on V3 and V2.1 and about AMMs generally and that kind of thing, which is like, what happens when the price, right, as if it should be, a proper noun. What happens when the price is something? And I think that what people are referring to is kind of the market consensus, right, on what something is exchanging at. And it's kind of fiction in crypto, right? The prices of things are generally kind of all over the shop. There is no sort of one fair agreed on price. If you go to any exchange right now, even for really well traded cryptocurrencies like ETH, there's still quite a lot of wiggle between not just the buying and selling prices, but also the buying and selling prices between different exchanges. So there is no like single price. A much better way to think about it is what price can you get, right? So not what is the price, because there is no such thing, but what will be the price if you take a certain action. So, for example, in Australia, SwiftX is like the subsidiary of Binance that Australian citizens are allowed to use, and if you go there, you'll see all of the tokens that they currently have listed, which is only a subset of everything that Binance offers everywhere else. And it will show you that, if you buy this number of tokens, this will be the price that you pay. And, they tend to quote you higher prices for like the more tokens you're planning on purchasing. That's the price, right? That is the price of the tokens that you are about to buy. And that is a much, much better way of thinking about things than, some number that is in CoinGecko or coming out of an Oracle price feed, because those prices don't really mean anything, right? They don't take into account the liquidity at that price, and they certainly don't reflect what you would likely receive for buying or selling a certain token. Now, this is kind of a long-winded, roundabout way of saying that if people aren't buying or selling anything at any point in time, then there is no price, right? It just doesn't exist. It's the same way on, if we come back to eBay or the pawn store example, right? If someone isn't buying that watch for $11,000, is its price really $11,000? Right? Of course, that is the asking price, and that asking price will always be there. But until someone actually agrees to pay it, you get to measure it, right? So it kind of exists in this kind of weird limbo state. And that is something that can potentially happen on Carbon, where, if there's there might be a very large gap between what users are currently asking for in either direction and what's happening on another exchange somewhere else, and that's fine. It's there is no requirement that these limit order books consistently trade tokens. It's just not something that they need to do any more than, the houses on your street need to consistently be sold or bought in order to maintain the real estate market, right? As long as there is a house being traded somewhere for something, then that's generally enough. Of course, it's better, right? And we're hoping that, especially for some popular tokens, that the spread will be very, very like razor thin. And I've had some conversations with some sophisticated individuals over the last couple of days who are expecting that, because of the way that Carbon is structured, that there will be sort of a razor thin spread for takers, which is good news for them. But for some more exotic tokens, right, for the, because Carbon is permissionless, people can start putting up orders for whatever they want. If you want to, put up an order for Doge Elon Mars tokens, you can. For Shiba Inu tokens, whatever, right? Some of these tokens, even though they're popular and people kind of know what they are, they're not that attractive to traders. And so I expect that, some of those orders might be sitting, gathering dust for a little while before they're executed upon. but that's not, that's not a bug, right? That's not the system failing or something. It's just someone asking for a price and, having the patience to wait for someone to take it. And that's totally fine. The system will tolerate that kind of stagnation without any trouble. It's really not a problem.
Right, I understand. Thank you. Another question was, how will Carbon get liquidity? Is it kind of geared towards the user base being more market makers? We were talking about empowering DeFi users earlier. Who would you consider the users to be, and essentially be providing that liquidity?
Yeah, there's a couple of different demographics. So I think that I've spent a lot of time talking about, for example, the day trader, right? I think that this is something that if people are starting to feel sort of a bit crowded out of things like, stocks and commodities or whatever, I know many, I don't know them, but I've met and spoken with many people that have often wanted to do like more stuff in cryptocurrency in terms of day trading, but don't necessarily want to day trade things like, Link and WBTC and ETH. They want to day trade something, for just a little while that token is very popular. And, it's very clear the reason why they might want to do that. Because, whenever there's a new hypey token out, it's the speculation on that token that tends to drive volatility. And that's really a day trader's, bread and butter. And so setting up range trading strategies with new exciting tokens and things that people are actively talking about and that sort of thing, right? This is a very important demographic for this product, right? And learning more about these people and reaching out to them and finding out why they haven't been using DeFi more often, or what it is that they need from a DeFi protocol in order to be successful. I would say that is probably, for me at least, one of the most important segments that we need to activate very quickly. But it's not the only one, right? I also know people that don't day trade, but do trade on very, very long time horizons. On the community call, I mentioned, some of the YouTube channels that I was watching back in sort of 2019 and 2020 that sort of got me interested in finance in the first place. And one of them is a very data science oriented approach, very sober, extremely disciplined. And that YouTube channel is run by a gentleman named Benjamin Cohen. And I haven't watched his videos in a while, but when I was there, he had this sort of metric for evaluating what the fair price of Bitcoin is likely to be, or where the market is likely to settle down. And it's not about calling the bottom or calling the top necessarily, because that's certainly not what he claims to do. But it's about sort of anticipating that natural sort of oscillation in the valuation of different cryptocurrencies. And so he's got a logarithmic regression band for Bitcoin. He's got a median price that that he's drawn right through the middle of it, and then essentially, when the price of Bitcoin is below that median, this is when it's a good idea, or in his view, it's a good idea to buy Bitcoin slowly. And the further Bitcoin, traces below that median, the more aggressively he's buying it. And then the opposite is also true. The further it moves above that regression band, the more aggressively he's selling it. That's exactly the sort of thing that you can do on Carbon that you haven't really been able to do on a centralized exchange without placing dozens or hundreds of limit orders. And it's not particularly high frequency, right? That kind of strategy, if you do have something like a logarithmic regression band for what you think the market is going to do over not a 4-hour timeline, but a 4-year timeline, then you can essentially execute that strategy automatically with only interacting with the smart contract, once, maybe twice, during a market cycle, and still achieve exactly the same thing that you would have by setting up dozens or hundreds of limit orders on a centralized exchange. So that's another really important demographic to access, right? These very long, long time horizon, I don't know what to call them, investors, I suppose, but people that aren't taking short-term bets, that are, they still accumulate tokens at low prices and still distribute them at high prices, but they do so very, very slowly and surely. So that's another really important demographic. But then I think and one that goes without saying, I hope, is also like sort of the institutional side. I think that we have a very good understanding of what is making DeFi so unattractive for some of the big trading firms and market makers to do things with, and we know that they are sort of experimenting with some AMM protocols, but in general, their complaints about using them are the same as native DeFi users' complaints. Things like the gas overhead is too high, or the speed and fidelity that I need to interact with my position frequently in order to manage my position is obscene, right? Because I can't just run an API the way that I would on a centralized exchange. I need to wait for my transaction to clear the mempool, and this is ridiculous, right? These kinds of things. And so with Carbon, because you don't need that kind of time fidelity, because if you fail to act quickly enough, you don't have to worry, because the sale of your token is irreversible, right? If the price retraces, the trader isn't going to be able to take advantage of that. They have to pay the spread no matter what. So these types of things means that we can also activate the professional side of things, right? The people that move very large amounts of volume, and professional market makers and trading firms. So these are to me, the three most obvious demographics to go after, and that is, I think, predominantly where the liquidity for Carbon is likely to come from, at least at first.
Awesome. Thank you. You said two things that I wanted to kind of touch on. You were talking about the automated strategies and the setup and how you can't, do this on a centralized exchange. And then you were saying that, you have to be able to act quickly and react to the market. And it brought me to a question that was submitted. In terms of DeFi, how does Carbon differ from Uniswap v3? We had spoken about how it differs from centralized exchanges, not so much anything that exists in DeFi at the moment. Yeah,
sure. So for Uniswap v3, it is still doing that. First, let's talk about the similarities. So the idea of choosing price ranges, right? Is going to feel pretty familiar. So, people that are long-term veterans of Uniswap v3 are already intimately acquainted with the idea of, breaking up the constant product bonding curve into little segments and then choosing just one of those segments that you want to interact with. No problem there. Where it's going to feel a little bit different, and I hope a little bit more powerful, is that there are no tick ranges on Carbon. You can choose literally any price. And this is, the reason why this is possible is because we've abstracted away a lot of what what is difficult, which is the matching and routing algorithms. And so we've, spent a lot of time making sure that we can get those done to give users that kind of flexibility. So you're no longer choosing specific buckets to put your liquidity into, but you have full agency, full autonomy to choose any price, and the system is just not organized into tick ranges the same way that Uniswap v3 is. So that's one one very pronounced, very specific difference. The other difference is the irreversibility. So with Uniswap v3, even though you can choose these ranges, once something is trading inside that range, it can still trade back and forth. So, even in Uniswap's white paper, they actually discuss, the use of their protocol as a limit order, as a limit order machine, and it's technically true if you're fast enough. So, for example, one of the things that you might do on Uniswap v3 is set up your liquidity within a very narrow range, like a one tick range, which I think is it's essentially 1 basis point, and then wait for someone to take you at that price, and then remove your liquidity from the protocol. Now, if you're lucky, you'll remove your liquidity before it has a chance to trade back the other direction. And if you're unlucky, it will have started to trade back the other direction before you can pull it out, which means that effectively, even though your limit order was once filled, it then gets unfilled as the market recoils after some move. And this is kind of the opposite to what you would expect of how a limit order to behave, right? On a centralized exchange, all sales are final, right? If someone takes you at that price, you've been taken at that price, right? The trader who took that order from the book can't sort of come back to it and say, look, I've changed my mind. I would rather, I want my dollars back and you can have your tokens back, please. And that's what happens on Uniswap v3. It's what happens on every AMM. And that's another very pronounced difference between Uniswap and Carbon. But I think, a lot of what I've said there sounds like I'm, critical of Uniswap, and that I just don't want anyone to think that that's the case. They are servicing very different, very different types of strategies, right? On Carbon, as I've said, and I hope I've made perfectly clear, it's about the difference in price that you can buy and sell something for, right? That really is the profit motive to using a protocol like the one that we're building. Whereas on Uniswap, it's really about the volume that you can support without the price moving. They're different. It's a very different bet, right? If you are confident that the price of ETH relative to DAI is going to be the same right now and this time tomorrow, then Uniswap v3 is a pretty compelling product. Because as long as the price wiggles around without moving very significantly in one direction, and if you're supporting a very large amount of trade volume with the small amount of liquidity that you're providing, then you can earn a lot of fees. The problem is that if the market moves, away from the current price, then the fees that you're earning might be very small compared to the opportunity cost that you've paid, right? And this is this is essentially the basis, the causal factor behind the effect that we call impermanent loss. On Carbon, that just doesn't happen because you're not making that gambit that the price isn't going to move anywhere. Quite the opposite, right? You are instead trying to profit from the price going somewhere, and that's something that's kind of new in an AMM context.
Thanks so much for summing that up. I didn't realize that we've been on for about an hour already, so I'm going to go through the rest of these questions here. One of them, speaking of other AMMs, was submitted by a community member. What is the best way to think of how carbon can be used by other AMMs? Meaning, could liquidity be routed from other major players through carbon? And they said, better
Yeah,
said, how can this be effectively leveraged to maximize fees for Bancor?
yeah, it's an excellent question. So yeah, I mean, being used by other AMMs, I mean, the routing through carbon's liquidity, I think, is going to be a really important, a really important thing. One of the things that I've often considered, right, or one of the things that's been on my mind recently is like, wouldn't it be interesting to see how like Uniswap v3 and Carbon sort of interact with each other, because they are kind of doing the opposite thing, right? Uniswap in a way is trying to get as much liquidity around the current price as it possibly can, whereas Carbon is kind of, shaped like a regular order book, right? It's got that V structure that you'll see on, that I'm sure you've seen on Binance or whatever API that you're using. And Uniswap is kind of the opposite, right? They kind of look like puzzle pieces where they can kind of fit into each other. And so, yeah, I am interested to see how, especially if that model continues to gain traction, and I suspect that it will, right? We've already seen Trader Joe on Avalanche start to adopt it's kind of it's not quite a Uniswap v3 clone, but it has a very similar sort of feel to it. They've added a few other bells and whistles, and I don't want anyone to think I'm being critical of them either, right? It's definitely its own thing, but it's very, 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 very similar, much to the point where if you understand the Uniswap v3 contracts, you already understand the Trader Joe contracts. But these systems, that particular AMM design, it really is focused on getting all of the liquidity that you can around whatever the current market price is, right? That is the only way to be profitable, right? Unless you're sitting, as I pointed out before, even the limit order argument, I don't think is a very good one. One, because no one seems to be doing it, and two, because you've got this weird, reversible execution that's just not how a limit order should behave. So Carbon being sort of the opposite number to that sort of design, it does suggest that there could be sort of a synergy there, where I'm interested to find out how people use it. It could be that there are going to be some sophisticated players that have liquidity on both of these protocols simultaneously, right? I think that is a relatively fair assumption, right? If you are long fees because you are expecting the price to go absolutely nowhere, then Uniswap v3 is a very attractive candidate. But then that doesn't mean that you don't have some other sort of macroscopic view of where the markets are headed. And so you might have, liquidity on Carbon simultaneously to buy and sell at certain prices as the market moves away from the price that you've contributed liquidity at on Uniswap. So it's about servicing entirely different ambitions, right? If you are a Uniswap v3 maximalist, because you love the idea of providing super tight liquidity around around a certain price and earning fees that way, then Carbon probably isn't the sort of thing that you're looking for, and that's fine. I think that being able to draw a line in the sand between different user behaviors and identify a niche that so far is being completely unoccupied is actually something that we've got to something that Carbon is has in its strong suit, right? It doesn't really makes sense to compete with Uniswap v3 in the traditional way, right? It's already doing its job very well, and I think that when they are present on other chains, a lot of the projects that are essentially cloning their contracts are going to, are going to find themselves crowded out, right? As, the reputation and levity that that Uniswap, brings with it is certainly going to draw a lot of user traffic as well. And I think that that's what we're trying to do here, right? We're not trying to copy that particular structure. We're trying to offer something entirely new, something different, right? Occupy an entirely different niche. And so, to maximize the fees on Bancor, as the user has asked, I think is also about finding where those synergies lie and helping to educate people about how these things fit together. Right, that it's not a decision of, do I want to do this or that, but how can I do multiple different things and either diversify my strategies or bolster them. Right, it's not about choosing one or the other, but learning to use everything. So I think that's probably the slightly hand wavy. I apologize for that, but that's probably the best response I can give you at the moment.
No, I appreciate that. Thank you. So we're talking about maximizing fees for Bancor. I have a question about reduced fees. You mentioned that Carbon will be permissionless. You can create a pair with any two tokens. So that leads to what specific, kind of a two-part question here. What specific role will BNT play? And will there be incentives like holding BNT for reduced fees?
Right. So at the, a lot of, we're getting into a lot of the stuff that is kind of dependent on the DAO's input, right? So like the overall skeleton of the system, the way that it works and that kind of thing, is, something that I'm happy to work on and talk about. Because it would be very difficult for a large decentralized organization to run a respectful research program and deliver this kind of content. So I can speak very intelligently as to what I think Carbon can and can't do, how it operates, that kind of thing. When it comes to BNT tokenomics and things, this is stuff that's really better situated to a discussion, with the DAO itself, whatever that means. But I can speak a little bit about, the ideas, what I consider to be the foundations for how these things will work. So there are both maker and taker fees in Carbon, and it's small. But it's there. I think we're talking about something like 1 basis point. I think is where I think it would be sensible to begin. So it's going to be fairly insignificant for anyone who's paying it. But in aggregate can actually amount to quite a large amount. The way that BNT I think could be or should be utilized is to essentially waive the maker fee for anyone who's making markets with the BNT token. And this kind of makes it a natural extension, or a natural continuation, spiritual succession, if you want, of BNT's utility up to this point, right? So BNT has always been the preferred numeraire of the Bancor protocol, and I think that it would be a shame to ever retire that. Again, coming back to some of the points that I've raised earlier in the call, I still think, illiquidity is the bane of crypto's existence, right? It's something that I don't want to see happen to BNT, and maintaining a very healthy, a very large, liquidity reservoir for the token, especially against a diversified, pair of other tokens, I think is great. And so waiving the maker fee and letting people make markets with BNT for nothing, I think that has both economic and, I think that has very real benefits, for the token itself. I also think that it's a natural reflection of the fact that the BNT token holders are the de facto owners of the protocol. Right. And so it makes no sense to charge yourself a fee to interact with it. So there's that component. And then there are other things that probably I shouldn't, that it would be inappropriate, I think, to talk about for the first time on a Twitter Spaces before I've had an opportunity to really, address it more specifically with the DAO on Discord or on Telegram. So I think I might just leave it there for now, but just know, for the person who asked that question, just know that with a system like this one, there are, there is a very wide scope of potential, like token applications for something like BNT. And, I haven't really had the opportunity yet to present these kinds of ideas to the DAO, and it's not a decision that I can make. And so I'm not really comfortable speaking about it on Twitter of all places first, before, the DAO has had a chance to read some documentation or something before.
Right. I respect that. Okay. So then I'm going to run through these. Will Bancor continue to build aside from Carbon, or is the Bancor brand being abandoned?
No, I mean, Bancor brand's not being abandoned. I mean, the Bancor brand is becoming General Motors. Right. Carbon is, it could be, you can think of that as like Cadillac, right? One of the subsidiary brands or one of the daughter brands of General Motors, right? Bancor is the umbrella brand under which a bunch of different products are developed and marketed to specific audiences, right? So like, for example, Lexus and Toyota are owned by the same company, right? They are owned by the same thing. In a way, the Toyota and Lexus brands are themselves just products because they're expected to, expected to appeal to very different audiences. The same way that, Chevrolet and Cadillac are expected to find different audiences, and GMC is expected to find, different audiences. There is, I would never support abandoning the Bancor brand ever. I think that the reason why, and I've seen, some of this stuff about, us trying to hide or something behind Carbon, and it's just nonsense, right? We, it's a literal anagram of the word Bancor for a reason. But no, it is its own product, and I think that it does make sense to give it its own, specific laser focused, targeted marketing campaign, and spinning it out with its own name and things, just makes that process a little bit easier. It also means that as we develop, and, speaking to the first part of your question, which is, are we going to, develop other things? Of course we are, right? There are, 180 elements on the periodic table. We've got a lot of potential product names to choose from. And I fully expect that there will be many, many, more, specific laser focused targeted, products with a specific audience in mind, that will have their own names, and they will all be under the Bancor umbrella.
I have a question about an actual, another product. Somebody asked if, will Carbon include a launch pad, allowing project ICOs with the necessity of holding a certain number of BNT in order to participate, for example, or also having projects paying a fee to list on Carbon?
Yeah, it's an excellent, it's an excellent question. In fact, due to some of the, I was reluctant to present my idea for Carbon in, to the smart contract developer team, because I knew how challenging it would be to realize, some of these things, like the matching and routing algorithm, for example, is extremely difficult. And so when I first presented some of these ideas, it was actually under the context of a token launcher. Right, there are things that you can do with these, with these flexible bonding curves, that I think that may ameliorate some of the problems that we've seen in how token launches have gone thus far. There was an academic paper that appeared just a couple of weeks ago, that was looking at the rate of token appearances, I think on Uniswap v2, I think that was the focus of the analysis, and how many of them were like specific scams. And, I know we're in a period of time now where, the word scam can just mean, a project that's, struggling or failed or whatever. But in this case, they were looking at specific malicious scams, right? So like tokens with, like honeypot catches in them, or with, an illiquidity bug in them to try and force the price up so that users are tricked into buying more of the token, that kind of thing. And it was an overwhelming majority. It was like 90 something percent, like 97.9%. I can't remember the exact number. I'm sure if other people read this paper, they might be able to quote the figure better than I can. And I remember thinking, like, there's clearly a need, right? Like, I in a way, I felt sort of vindicated for presenting that token launcher idea in the first place, because it's clearly something that our industry is suffering with, and that there probably needs to be something something better than that we already have in order to address it. And when I was doing that kind of stuff, I was looking at things like Copper Protocol, and which is a token launcher built on, I think, Balancer, and others. There are a bunch of token launcher products out there. I remember Sushi had a token launcher product that was actually pretty good. It even had like a really nice looking UI. And I think only 2 projects used it, which is such a shame, because it was like, I thought it looked great, and the contracts were great, and the idea behind it was great. But for whatever reason, it just didn't catch on. So, there is this, balance, I think, between, what do you think a token launcher should be, and what defines a great token launcher, and what do people want to use with it? Because it could be that you design inadvertently a malicious tool that people want to take advantage of in order to to perform honeypot scams or whatever, and that would be terrible. And so maybe building into a token launcher something that offers essentially new investors some sort of level of assurance, right? Something that distributes funds back to the developers at a constant rate or something, so that they can be more confident that the project that they are investing in is legitimate. This kind of thing, right? There's a lot that can be done that I think was kind of skipped over by some of these token launcher products out there. And yes, absolutely. Carb, I've already demonstrated if that user specifically wants to see some of the research that I've done surrounding token launches and how you can do sort of early price discovery or price stabilization, I'd be very happy to share that material with them. But yes, it's I fully expect that we'll have a dedicated token launcher platform. It's been an ambition of the Bancor project for at least 2 years, right? At least as long as I've been associated with the project, and to have something that is as sharp, right? That's as flexible, as appropriately suited to the task as Carbon is, I think is the opportunity that we've been waiting for to finally do something about it.
Awesome. Thanks, Mark. Somebody listening in on the call right now submitted a question, so it's a little bit off topic in terms of, new products and things, but I'd like to ask you, trading directly from their wallet, like they're asking, from a trader's point of view and the user experience, whose wallet, and is there an extra wallet necessary for gas? So like directly from their wallet, they'll be trading with Carbon via smart contract with their permission. I think they're just looking to clarify that.
Can you read out exactly what they've written?
Sure. Exactly what they wrote is, can we ask from a trader's point of view, user experience, whose wallet, extra wallet for gas, and multi-chain? All separate questions.
Okay.
And then,
so from the traders, okay. from a taker's perspective, I mean, they're both traders, right? In Carbon, there are traders on all sides of this thing. The taker, right, is the person that is looking at the prices that are available and then deciding whether or not they take those prices. And the maker is the person that puts the price tag on the token. Okay, so maker prices the token, taker decides whether or not they're going to buy it. The taker is going to feel exactly the same as it does with AMMs already, right? There is no, you just interact with the smart contract the same way you do on any AMM right now. You can use the the routing algorithm that we've developed to find the best possible combination of different user orders to interact with, so that you get the maximum number of tokens that you're trying to buy at the best possible price. Or you can interact with orders individually, directly via the smart contracts without using the routing algorithm. It's really up to you. So in that sense, there is no, there is no intermediate contract for you, right? You will just trade against the system the same way you perform a trade on 1inch or Uniswap or anywhere, right? It's going to feel exactly the same. For the maker, right, the people that are pricing their tokens, it will feel exactly the same as adding liquidity to any liquidity protocol. With the caveat being that you choose your own price. So rather than approaching a constant product AMM pool with some ratio of ETH to USDC, and saying, here is my liquidity, and trade it at the current market price. Instead, you will create two separate bonding curves, one with a buy price and one with a sell price, if you want to think about it that way. And you tell the protocol what those prices are, and you can provide any amount of either of those tokens, including 0. So, that's a smart contract interaction that's going to feel very much like liquidity provision, but just with a little bit of, extra opportunity there for the user, the maker, to give the protocol some instructions about what they want to do with those tokens. That's it. So there's that component. For the multi-chain stuff, I do, I have already been speaking with, a couple of other, a couple of other blockchain projects that are, that are very interested in seeing Bancor, on their chain. This has been a consistent theme over the last couple of years. And I think, this is probably something that's, again, best discussed, with the community first. And so I don't think it's appropriate to mention it on Twitter Spaces before we mention it there. And Tyler will, I think, have a lot more to say about it. Certainly more in a much more authoritative way than I can. But yeah, personally speaking, I'm very, anxious, right? I'm as frustrated as everyone else. The Bancor project is still a single chain project. I would like to see it on as many layer 2s and alternative layer 1s as we see fit. And a lot of the security risks that we we're sort of burdened by with previous iterations of the system have kind of gone away in this one. So Carbon, even more so than anything we've done before, should be, we shouldn't feel any sort of sense of reluctance as a community or as a DAO to put it anywhere we want to. It can and should happen.
Awesome. Thank you so much. I have 2 more questions. We'll run through those. Will Bancor wait for the market to move steadily upwards to get a bigger return on launch, assuming the market, is as it is at the moment?
I mean, personally, I don't, I don't think that that's something that we should, concern ourselves with. But obviously, this is a DAO. Again, it's a DAO decision. after these proposals start appearing on discourse and the DAO has time to consider it, I think it may be worth introducing that aspect to it, right? Either via snapshot or some other process to see if we can get some consensus about timing. But yeah, in my opinion, waiting for the market to get better, one might be waiting a rather long wait in this case. So yeah, I would say that we just build and do stuff, right? And I think there is no without knowing precisely how long the bear market is likely to last, and it could last quite a bit longer than people want it to. And to look back and say that we wasted all this time when we could have had, some product out and be learning more about how people are interacting with it and that kind of thing, I think would be a mistake. I think it's also worth pointing out that having, this kind of bid-ask system or, and the ability to create a spread with two tokens or more than two tokens is something that might actually be very worthwhile in a bear market, right? So in general, in a bull market, you're generally pretty well off just buying something and sitting on it for 6 months and then selling it. Whereas in a bear market, channel trading and range trading and that kind of thing is kind of what might be a much more rewarding, thing to participate in. And so to have Carbon ready and people that are, trying to make money during the bear, it might actually be the most opportune time to give them those tools, because it could be that it gets a lot more traction during a market climate like the one that we're in now, even more so than when the cryptocurrency markets turn bullish. So yeah, I don't think we should wait, but it's not my decision.
That makes sense what you're saying. Okay, last question. Speaking of building and developing, is Carbon in production or planning phase?
Oh, it's been in production for months. This isn't we weren't just working on white papers and stuff, right? The smart contract work, UI work, the SDK and everything else, right? This has been happening, since July. So it's it's very, very much in production. This isn't just the first time where we're talking about some cool idea we have. This is talking about something that is almost ready for its debut. Hello, hello. I think my phone is froze.